Welcome to the deep dive. Today we are strapping in really for quite an intensive journey. We're looking into the global economy's kind of secret rulebook, Section 482 of the Internal Revenue Code.
Yeah, it sounds dry, Section 482, but it's really not just some obscure tax statute. It's the entire framework that governs how big multinational corporations do business with their own subsidiaries.
Right, like selling inventory between related companies.
Exactly. Selling inventory, lending money, licensing intellectual property, you name it. And the whole point is making sure those internal deals, reflect market reality.
And that's the core tension, isn't it? The thing we're tackling today, our mission really, is to decode this pretty dense regulatory framework. It basically tries to force controlled companies to act as if they were complete strangers dealing with each other. So if you want to understand how countries try to stop profits from, well, magically shifting to low-tax places, Section 482 is really the law you need to get your head around.
Absolutely. And the main goal of 482, it's actually quite clear, and it's twofold. First, make sure taxpayers clearly show the income that comes from their controlled transactions.
Okay, clear reflection of income.
Right. And second, crucially, prevent tax avoidance. And this is done by requiring what the regulations call tax parity.
Tax parity, so putting a controlled company on the same level tax-wise as an independent one.
Exactly. Placing a controlled taxpayer on, let's say, an equal footing with an uncontrolled or third-party taxpayer. And that foundational principle, the real cornerstone of global transfer pricing, is the arm's length standard, the ALS.
The ALS. Okay, but before we dive into the nuts and bolts of pricing methods, we should probably clarify who actually has to follow these rules. Who counts as a controlled taxpayer?
Good question, because the definition is incredibly broad. It has to be, really, to catch all the complex global setups companies use. So a controlled taxpayer is any one of two or more entities, could be corporations, partnerships, whatever, that are owned or controlled directly or indirectly by the same interests.
Indirectly, so not just straight ownership.
Correct. And here's where it gets powerful from a regulatory standpoint. Control is based on the reality of the control, not just the legal form, not just what's on the share register.
Okay. So even if the org chart doesn't show, say, a direct majority stake, if two companies are essentially acting together under some common direction or influence, the IRS can say, nope, you're controlled.
Precisely. It's about the substance over the form. It even covers two or more taxpayers who are just acting in concert, working together towards a common goal, even if they don't look related in the traditional sense on paper. The focus is really on the operational ability, the managerial power to influence pricing or business behavior.
Wow. Okay, that's broad. And the scope of transactions this applies to must be just as big then. We're not just talking about selling widgets back and forth.
No, definitely not. The term transaction is deliberately defined in the broadest way possible. It covers any sale, any assignment, lease, license, loan, advance, even contributing capital, or just performing any kind of service for the benefit of another member of the controlled group.
So pretty much if money or value moves between related companies in any way.
Section 482 applies.
Yep.
If value shifts, these rules kick in.
Okay, so for this deep dive, we'll navigate this by first looking at the bedrock principle economic substance, then move into the general factors the IRS uses for comparing transactions, and finally, we'll really get into the weeds with the specific methods used to actually justify the prices charged. This is kind of the ultimate guide to the global corporate tax playbook, isn't it?
You could say that. It's certainly a critical part of it. #TechTake2, the arm's length standard ALS and economic substance.
Right. Let's start with the arm's length standard itself, the ALS. The basic idea seems simple enough to deal with your subsidiary like you would a stranger. But how it works in practice, especially around adjustments, that raises questions straight away. The IRS can obviously adjust income, but can the taxpayer do it themselves?
That's a really important point, and it shows the sort of asymmetry built into the rules. So the core principle is always, true taxable income is figured out by comparing the controlled deal to what an uncontrolled taxpayer would have done. Now, a controlled taxpayer can report results on a timely filed tax return based on the ALS, even if those prices are different from what they actually charged internally.
Wait, so they can report higher income than they actually booked?
Yes, and often it is an upward adjustment, increasing their taxable income. They might do this proactively, before an audit even starts.
Why would a company ever voluntarily pay more tax? That seems counterintuitive.
It does, but it's almost always a defensive strategy. It's about managing penalty risk. If an audit later finds that the taxpayer should have reported significantly higher income in, say, the U.S., there can be massive penalties, really substantial ones.
Ah, okay. So by making that adjustment themselves up front and reporting the higher income on time.
They're essentially showing they made a good faith effort to comply with the arm's length standard. That often protects them from those really big penalties, even if the IRS later tweaks the number slightly. But, and this is key, they generally cannot file an untimely return or an amended return later on to decrease their taxable income based on a 482 adjustment. That power to decrease income based on 482 pretty much rests solely with the IRS district director.
Right, so the IRS holds the cards on downward adjustments. Okay, now here's where it gets really interesting, I think.
Yeah.
The idea of economic substance over form. I'm fascinated that the IRS isn't just bound by whatever fancy contract the lawyers drafted.
Oh, absolutely not. The contract is just one piece of evidence, and frankly, sometimes it's not the strongest piece. The regulations are very clear. The greatest weight is given to the actual conduct of the parties.
Wow.
What did they really do? What were their respective legal rights in practice, regardless of what the written contract says?
So if the contract says one thing, but the companies act completely differently.
The director can, and often will, disregard those contractual terms if they're inconsistent with the underlying economic substance, the economic reality of the situation.
And even more than just disregarding terms, they can actually impute terms, make up contract terms that weren't even written down.
Precisely. The power to impute a contract based on how the parties behaved is a really significant tool for the IRS. Let's take that manufacturing example from the outline. Say you have a U.S. parent company that owns a manufacturing subsidiary abroad. The sub is running flat out, full capacity, churning out components.
Okay.
And year after year, the subsidiary sells its entire output to the parent. But maybe there's no formal long-term purchase agreement in place, just ongoing orders.
Right. If that was a real arm's length deal, that manufacturer would be facing huge market risk, wouldn't they? What if the customer suddenly stopped buying?
Exactly. That's the key risk. But if the actual conduct shows the parent is consistently taking everything the subsidiary makes, decade after decade, the IRS can step in and say, look, the economic reality here is like a long-term contract. They can impute a purchasing contract, one that essentially guarantees the producer will sell its full output.
And the consequence of that imputed contract
Is that the subsidiary, the producer, is deemed to bear very little market risk. Its profits should then reflect that low-risk reality.
Yeah.
So the margins allocated to that subsidiary have to be consistent with what a low-risk, guaranteed volume contract manufacturer would earn, not what some high-risk entrepreneurial producer taking market chances might get.
So the way the business actually operates day to day defines the tax outcome, not just the paper trail. That ties directly into this critical area of risk assumption. You hear stories about companies trying to shift risk, right? Allocating huge market risk or currency risk to some shell company in a tax haven that doesn't really do anything. How did the rules stop that?
Yeah, that history is exactly why the regulations are so strict on risk. An allocation of risk in a contract will only be respected by the IRS if it passes a sort of three-part test. This ensures the risk allocation is genuine, not just, window dressing on a contract.
Okay, what's the first test?
The risk allocation must have been agreed to before the outcome of that risk was known or could be reasonably known. Simple anti-abuse rule. You can't wait to see if you made a profit or loss on foreign exchange and then sign a contract saying your Cayman Islands subsidiary bore the currency risk all along for the past year.
Right, no retroactive risk shifting. Makes sense.
All right.
What's the second check? This sounds like it targets those shell companies you mentioned.
It absolutely does. This is crucial. The controlled taxpayer, who supposedly assumes the risk, must have the financial capacity to actually fund the reasonably expected losses from that risk.
Financial capacity. So they need enough cash or assets.
Enough capital, yes, or reliable access to funding. It doesn't mean they need cash sitting there to cover the absolute worst-case scenario on day one, but they need sufficient capitalization or perhaps documented, credible guarantees from the parent or group that an unrelated lender would actually respect to show they could genuinely withstand the potential losses associated with the risk they've supposedly taken on.
Okay, let's use that example. The foreign distributor, FD, contracts to buy 20,000 widgets a year, supposedly taking all the market risk if they can't sell them. But FD only has, say, $100,000 in capital.
Right. And if the potential loss from being stuck with those 20,000 widgets could realistically be, let's imagine, $5 million, well, that $100,000 in capital is clearly nowhere near enough. It's not credible financial capacity for that level of risk.
And what if the U.S. manufacturer, USM, just keeps shipping widgets to FD on credit, even when FD clearly can't pay because it can't sell the inventory?
That's the conduct piece again. If USM keeps extending credit, essentially propping FD up and preventing its collapse despite the market failure, USM's actions demonstrate that it is the one truly bearing the financial consequences of the market risk. The regulations look at that conduct. USM suffers the loss when FD can't pay.
So even if the contract says FD bears the market risk, the IRS can say no, based on your actions and FD's lack of capital, USM actually assumed the risk.
Exactly. The contract is overridden because the economic substance, FD's inability to absorb the loss, and USM's conduct in funding it, contradicts the contractual term. The risk, and therefore the profit or loss associated with it, must be allocated to USM to reflect that reality.
Okay, financial capacity is key. What's the third check on risk? You mentioned managerial control.
Right. This ties risk back to function. It ensures alignment. The taxpayer, assuming the risk, must also exercise managerial or operational control over the actual business activities that directly influence the amount of income or loss realized from that specific risk.
So if FD is supposedly taking on the foreign market risk,
Then FD needs to be the one actually making the important, non-routine decisions about things like local pricing strategy, major marketing campaigns in that country, setting inventory levels, deciding which local distributors to use, and so on. If all those critical decisions are actually being made back at USM headquarters, and FD is just, executing instructions,
then FD isn't really controlling the activities that manage the market risk.
precisely. In that case, FD looks more like a routine agent or facilitator, not the entity genuinely managing and controlling the market risk. So the risk allocation to FD would likely be disregarded again, even if it had the financial capacity. The control has to be real. #tag 3. General comparability factors and adjustments.
Okay, so once we've sorted out the economic substance, who's really doing what, who's really bearing risk, we get to the core task of finding a comparable, uncontrolled transaction to benchmark the price against. This requires working through a pretty strict comparability checklist.
Yeah, this checklist is really the foundation of almost every transfer pricing analysis globally. If you can't demonstrate sufficient comparability between the controlled transaction and the potential uncontrolled comparable, you really can't reliably use that comparable to set or test your price. And it starts with the functional analysis.
Functional analysis, meaning comparing what functions the related parties actually perform versus what the potential third-party comparables do.
Exactly. You have to break it down. Who's doing the R&D? Who's responsible for product design and engineering? Who actually owns the manufacturing plants and equipment? Who's driving the marketing and distribution strategy? Who's handling the back office stuff like legal, finance, HR?
Because differences in those functions usually explain differences in profits.
Absolutely. That's the main driver. Think about a distributor. Is the controlled distributor just doing basic warehousing and order taking? Or are they doing high-level strategic marketing, adapting the product for the local market, managing complex warranty claims, and investing heavily in brand building? Those are vastly different functional profiles, and you'd expect very different profit outcomes. You can't compare a simple logistics provider to a full-risk strategic market developer.
Okay, function is first. Then we look at the contractual terms. This seems like where the small print really matters.
It does. The specific terms of the deal can have a big impact on price. Think about sales volume, for instance. We had that example. PE buys 60 units from its controlled supplier.
Yeah.
The potential market comparable data shows maybe an unrelated company gets a 2% discount for buying 20 units and another gets a 5% discount for buying 100 units.
So what discount should P get for buying 60? It's somewhere in between.
Right. The IRS needs to know, or you need to show, what discount a third party buying 60 units would likely receive in that market. You might need to make an adjustment to the comparable data to reflect that difference in volume and the expected volume discount. It has to be reliable, of course.
And other terms matter too, like payment terms.
Oh, definitely. Warranty terms, who bears the cost of repairs? Credit terms, does the controlled buyer get 120 days to pay, while unrelated buyers only get 30 days? That extended credit is essentially a loan, it has value, and the price might need adjusting for that implicit financing benefit. Payment terms, transport terms, who pays for shipping, all those details matter.
Makes sense. The third big area is economic conditions. We need to be sure we're comparing deals in similar market environments.
Exactly. You need to look at the similarity of the geographic markets. Are we comparing a sale in a mature, highly competitive market like Western Europe with one in a rapidly developing, less competitive market in Southeast Asia? Market size matters, the stage of market development, the market shares of the companies involved, how much competition there is overall.
And a really critical factor here is location-specific costs, right? Which brings us to that classic issue, location savings.
Ah, yes, the location savings dilemma. This comes up all the time. Let's use the example. A subsidiary, call it SUCO, manufactures clothes in country Y, where labor costs, rent, utilities, everything is significantly cheaper than in, say, the U.S., where the parent company, Couture, is based.
Intuitively, you might think SOCO, the manufacturer in the cheap location, should get to keep all the extra profit generated by those lower costs.
That's the common intuition. But this is where the arm's length standard forces us to think about market dynamics. Those lower costs in country Y might justify higher profits for SUCO, the manufacturer, but only if comparable independent manufacturers operating in country Y would also be able to capture and retain those savings, given the competitive conditions in country Y.
Okay, so if SOCO is just making basic t-shirts and there are like 50 other factories in country Y that can make the exact same t-shirts just as cheaply.
Then those 50 factories are all competing fiercely for Couture's business or any other buyer's business. That intense local competition will drive the selling price of those t-shirts down.
So Couture, the U.S. parent, wouldn't have to pay a high price to SOCO. It could just go next door and buy from an unrelated factory at a price reflecting those low country Y costs.
Precisely. In that highly competitive local market, the location savings don't stick with the manufacturer, they get competed away. The benefit flows through to the customer, Couture, in the form of lower purchase prices. SOCO would only be entitled to a normal manufacturing profit margin typical for that competitive environment.
So SOCO only gets to keep the big profits from location savings if it's doing something unique in country Y that competitors can't easily replicate at the same low cost.
Exactly. Maybe it has unique know-how, a patented process, unique access to skilled labor, something that gives it a competitive advantage within country Y that allows it to command a higher price even from third parties. Absent that, the savings generally flow to the buyer. It makes the whole tax question dependent on analyzing the external market conditions in country Y, not just SUCO's internal cost structure.
That really highlights how outward-looking this whole process is. And of course, sometimes you just can't find a good comparison. What makes a potential comparable transaction unreliable?
Well, there are a couple of main reasons. First, transactions that are not made in the ordinary course of business.
Like a fire sale.
Yeah, exactly. If Comco, a competitor, is going bankrupt and liquidates its entire inventory at rock-bottom prices just to get cash quickly, that liquidation price isn't representative of a normal, ongoing, arm's-length business deal. It's driven by distress, not typical market forces. So you can't reliably use that price as a benchmark for an ongoing supply arrangement.
Okay, distress sales are out. What's the other main reason a comparable might be unreliable? Something about intent.
Right. If one of the principal purposes for entering into the uncontrolled transaction was specifically to establish an arm's length result for a controlled transaction, this is about manufactured evidence.
Can you give an example?
Sure. Imagine a U.S. parent, USP, normally sells almost all its output to its own foreign subsidiary, FSUB. USP is operating at, say, 95% capacity. Now, USP decides to slightly increase its production, just enough to sell a very small amount of excess product to a totally unrelated foreign distributor, FDDist, at a particular price. If USP's main reason for doing that small deal with FDist was just to create a handy benchmark price to justify the price it charges to its own subsidiary, FSUB,
Then that deal with FDist is tainted.
it's considered tainted, yes, unreliable. Because its primary purpose wasn't genuine business expansion or market diversification, it was to create a transfer pricing comparable. It lacks that independent organic business motivation the IRS looks for in a reliable benchmark. Hashtag tag PLIs. Specific transaction methods for pricing.
Okay, we've laid the groundwork, economic substance, comparability factors. Now let's get into the actual pricing mechanics for different types of transactions, starting with maybe the simplest or seemingly simplest, loans and advances between related parties.
Right, section 1.482-2 deals with this. And the very first step is critical. Are we actually dealing with a real loan? The rules only apply to bona fide indebtedness.
Meaning real debt, not something else disguised as debt.
Exactly. If the transfer of funds looks and behaves more like a contribution to the subsidiary's capital, maybe there's no fixed repayment schedule, no interest being charged or paid, the sub is very thinly capitalized, the IRS might recharacterize it. They'll say it wasn't a loan at all, it was equity. Or maybe payments look like disguised dividends. If it's not true debt, then these interest rules don't apply. It gets treated according to its actual substance.
Okay, assuming it is a genuine loan or advance, what about things like regular intercompany accounts payable? Invoices for goods or services sold. Does interest have to be charged immediately?
Not usually. For what are called intercompany trade receivables, basically. Debt that arises in the ordinary course of business from sales, services, leases, etc., and isn't formally documented with a written loan note, there's generally an interest-free period.
A grace period, essentially.
Sort of, yeah. The clock for charging interest doesn't start ticking on day one. The specific rules for how long this period lasts can get a bit detailed, but for instance, if a U.S. parent sells goods to its foreign subsidiary, and that subsidiary is going to resell them in its local foreign country,
Okay.
the length of the interest-free period allowed on that payable back to the U.S. parent can often be determined by looking at the foreign subsidiary's own average collection period on its sales to unrelated customers in that same foreign country.
So it tries to mirror the normal business cycle and credit terms in that specific foreign market.
Exactly. You typically calculate it by looking at the subsidiary's monthly sales and accounts receivable balances from its third-party customers to figure out, on average, how long it takes them to collect payment. That period then becomes the interest-free period for the related party debt.
That seems pretty reasonable. Okay, now for actual formal intercompany loans where interest definitely needs to be charged, how do we know the rate is arm's length? Is there a simpler way than finding comparable bank loans?
Yes. Thankfully, for many common situations, there is. It's called the safe haven interest rate range. This is a major administrative simplification provided by the regulations.
The safe haven. Okay, how does that work? What's the range?
It's tied to the applicable federal rate, or AFR. If the interest rate charged on the intercompany loan falls anywhere within the range of 100% to 130% of the AFR for the appropriate term of the loan, then the rate is automatically considered arm's length. The IRS generally won't challenge it.
AFR, applicable federal rate. Where does that come from?
The AFR is a set of interest rates published by the IRS every month. They represent the bare minimum interest rate the government believes should be charged on loans to avoid having imputed income. There are different AFRs depending on the loan's duration, short-term, up to 3 years, mid-term, over 3 up to 9 years, and long-term, over 9 years.
So you pick the AFR for the right loan term, say it's 5%. The safe haven range is then 5% up to 1.3 times that, which is 6.5%.
Exactly. If you charge any rate between 5% and 6.5% inclusive, you're generally safe under this rule.
What if you charge outside that range? Say you charge 7%, which is above 130% of the AFR, or you charge only 4%, which is below 100%.
If the rate charged is outside the 100%, 130% range, the IRS will typically adjust the interest rate to the closest end of that safe haven range. So if you charge 7% when the top end was 6.5%, they'd usually adjust it down to 6.5%. If you charge 4% when the bottom end was 5%, they'd adjust it up to 5%.
Unless you can prove the rate you actually charged was arm's length.
Right. The safe haven isn't mandatory. If you charge 7% and can provide strong evidence, like data, from comparable loans between unrelated parties under similar circumstances, considering the borrower's creditworthiness, collateral, currency, etc., showing that 7% was a market rate, then that rate should be respected, even though it's outside the safe haven. But the burden of proof is on you.
And are there any big exceptions where this safe haven just doesn't apply at all?
Yes, a couple of important ones. First, it generally does not apply if the lender in the controlled group is regularly engaged in the trade or business of making loans or financing transactions with unrelated parties. Think of a group's internal finance company. They have their own real-world benchmarks, so they don't need the safe haven.
Okay.
Second, the safe haven generally doesn't apply if the loan is denominated in a foreign currency. Those loans involve currency risk, which isn't factored into the AFR. For foreign currency loans, you typically need to find market comparables for loans in that specific currency.
Right, that makes sense. Okay, let's move from money to actual stuff. Tangible property transfers. Selling goods. The rules seem to prioritize certain methods here. What's considered the best, the gold standard?
For tangible goods, the regulations state a clear preference for the comparable uncontrolled price, CUP method, if you can find a reliable CUP.
CUP, comparable uncontrolled price. So finding the price of the exact same product sold between unrelated parties.
Ideally, yes. Or a very, very similar product under very similar circumstances. CUP is considered the most direct and reliable measure of an arm's length price because it's based on actual market transactions for the item itself. But that high reliability comes with a big string. Exactly. That's the classic example. Let's say a U.S. manufacturer, USM, sells its famous high-value branded widgets to its own controlled distributor overseas. USM also sells some identical widgets, but without the brand name, maybe generic or under a different minor label to an unrelated third-party distributor.
Okay.
The price difference between the branded widgets sold to the subsidiary and the unbranded one sold to the third party might be significant. That difference is mostly due to the value of the trademark, the brand equity. If you can't reliably figure out how much that brand name is worth, how much it contributes to the price difference.
Then you can't reliably adjust the price of the unbranded widgets to make it comparable to the branded one.
Correct. You can't isolate and quantify the brand's impact accurately enough. In that case, the transaction involving the unbranded widgets fails as a reliable CUP for the branded widgets, even if the physical products are identical. The presence of valuable, non-routine intangibles often kills the CUP method.
Okay, so if CUP doesn't work, which is probably often the case with unique or branded goods, where do we go next? The regulations mention margin-based methods. Let's start with the resale price method, RPM.
Right. RPM is typically used for transactions involving distributors or resellers, companies that buy property and then resell it to other parties. The key condition for using RPM is that the reseller has not added substantial value to the goods before reselling them.
What counts as substantial value if they just put it in a different box?
Simple packaging, labeling, maybe some minor assembly that's usually considered not substantial value added, RPM is appropriate there. But if the reseller is doing significant modifications, incorporating the product into another system, or performing extensive quality control that adds significant value, RPM probably isn't the best method.
Assuming the reseller doesn't add substantial value, how does RPM work? It starts from the selling price.
Yes, it works backwards from the price at which the reseller sells the property to an unrelated customer. You take that final resale price, and then you subtract an appropriate gross profit margin. What's left is deemed the arm's length price that the reseller should have paid to the related party manufacturer or supplier.
And how do you figure out the appropriate gross profit margin?
By looking at the gross profit margins earned by comparable unrelated distributors performing similar functions and taking similar risks with similar types of products.
So the focus shifts from the product itself, like in CUP, to the functions the distributor performs.
Very much so. Comparability under RPM depends heavily on the similarity of functions performed by the controlled reseller versus the uncontrolled comparables. Are they doing similar levels of inventory management? How much advertising and marketing do they undertake? Do they handle warranty administration? What are their payment terms with customers?
And accounting consistency is crucial here too, right?
Absolutely critical for RPM. Because you're comparing gross profit margins, you need to be certain that the controlled taxpayer and the uncontrolled comparables are calculating gross profit in the same way. For example, how are costs like discounts, returns, allowances, freight in, or warehousing insurance treated? Are they included in the cost of goods sold, which affects the gross margin, or are they treated as operating expenses below the gross margin line?
If they account for those costs differently,
then their gross margins aren't truly comparable, even if their functions look similar. A small difference in accounting classification can dramatically skew the gross profit margin percentage, making the comparison unreliable. You need very consistent accounting practices for RPM to work well.
okay, so RPM looks at the reseller's margin. What's the alternative margin method, the cost plus method, CPM?
Correct. CPM flips the perspective. Instead of looking at the reseller, it typically looks at the manufacturer or producer of the tangible property, or sometimes a service provider. But let's stick to goods for now.
And instead of starting from the resale price, it starts from
the cost of producing the property. CPM determines the arm's length price by taking the controlled manufacturer's cost of goods sold for the property, transferred to the related party, and then adding an appropriate gross profit markup.
a markup on the cost. And again, that appropriate markup comes
from looking at the gross profit markups earned by comparable unrelated manufacturers performing similar functions, bearing similar risks, and operating under similar market conditions.
So like RPM, the key comparability factors for CPM are functions performed and...
Yeah, again, accounting consistency is absolutely vital. You need consistency in how costs are classified between cost of goods sold and operating expenses. If the controlled manufacturer, say, includes certain supervisory or R&D overheads in its cost of goods sold, but the potential comparable companies treat those same types of costs as operating expenses below the gross margin line, their gross profit markups aren't comparable. CPM relies just as heavily as RPM on consistent cost accounting between the tested party and the comparables.
Makes sense. Both RPM and CPM rely heavily on finding comparable functions and consistent accounting for gross margin. Now, let's pivot to what's often the most valuable and probably most contentious area: intangible property transfers. This covers everything from patents for blockbuster drugs to software algorithms to famous brand names.
Absolutely. Intangibles are often the crown jewels driving huge amounts of profit. The regulations define intangible very broadly. Patents, copyrights, trademarks, brand names, franchises, licenses, formulae, processes, designs, know-how, methods, programs, systems. Basically any similar asset that has substantial value independent of the services of any specific individual.
And valuing these unique assets must be incredibly difficult. How do the methods work here? Is there a preferred method like CUP for tangibles?
There is a preferred method, conceptually similar to CUP, called the Comparable Uncontrolled Transaction CUT method.
CUT, comparable uncontrolled transaction. So finding an unrelated party license of the same intangible.
Yes, or a license of a highly similar intangible under highly similar circumstances. Like CUP, CUT is considered the most direct and reliable method if you can find a good comparable. But also, like CUP, the standards for comparability are extremely high, especially for intangibles, which are often unique by their very nature.
What makes comparability so tough for intangibles under CUT?
Comparability for intangibles depends heavily on ensuring the intangibles have similar profit potential. This is a key factor. Even if the intangible itself is identical, the circumstances of its use can drastically alter its profit-generating ability.
Can you give an example of how profit potential difference ruins a CUT?
Sure, think about the example of licensing a patent for a new drug, drug Z. Let's say the U.S. parent licenses drug Z to its subsidiary in country X. We find an external license agreement where the same drug Z was licensed by an unrelated company to another unrelated company for use in country Y. Looks like a perfect CUT, right? Same drug.
Seems like it.
But what if the disease that drug Z treats is 10 times more prevalent in country X than it is in country Y? The market size, the sales potential, and therefore the profit potential from using that drug Z patent is vastly different between the two countries.
So the value of the license is fundamentally different in country X versus country Y, even though the underlying patent is the same.
Exactly. The expected revenue stream in country X is much higher. Trying to use the royalty rate from the country Y license as a benchmark for the country X license would likely be unreliable because the profit potential is materially different, and accurately adjusting for that difference is usually highly speculative. CUTs often fail due to differences in profit potential related to market size, competition level, or other economic factors.
This inherent difficulty in finding good comparables and valuing unique intangibles, especially looking forward, is that why Congress brought in this really powerful rule, the Commensurate with Income (CWI) standard, back in 1986.
That's precisely why. CWI was a game changer. It essentially says that the payment for an intangible property transfer, typically a royalty, must be commensurate with the income attributable to the intangible. It acknowledges that the true value of an intangible might not be known up front and can change dramatically over time.
And the striking part of CWI is that it allows the IRS to look back years later and adjust the royalty rate.
Yes, that's the enforcement mechanism. Periodic adjustments. The CWI standard requires ongoing monitoring. The IRS has the authority to review the royalty rate or other payment structure in a later year and make adjustments if the actual profit experience turns out to be substantially different from what was projected when the deal was first struck.
Substantially different. Is there a specific threshold for that?
Yes, there's a sort of safe harbor band, but it works in reverse. An adjustment is generally presumed appropriate if the actual profits or cost savings realized by the licensee, the party using the intangible, fall outside a band of 80% to 120% of the prospective profits or savings that were reasonably foreseeable at the time the agreement was made.
Outside 80% to 120%. Okay, let's use that example. Eurodrug licenses a new drug patent from its U.S. parent. When they signed the deal, they projected total profits over 5 years of, say, $1,400 million. But things go unexpectedly well, and the actual profits over those 5 years turn out to be $2,850 million.
Okay, $2,850 million is more than double the projection of $1,400 million. That's way outside the 120% upper limit, which would be $1,680 million.
So that triggers the CWI adjustment.
Almost certainly. The IRS isn't saying Eurodrug should have had a perfect crystal ball, but a variance that large suggests the original royalty rate might not have adequately reflected the intangible's true income-generating power, at least not as it actually played out. The initial deal wasn't commensurate with the income eventually generated.
And how does the adjustment work? Can the IRS go back and change the taxes for those earlier years where the profits were already booked?
This is important. Generally, no. If those earlier years, say years 1 through 4, are already closed by the statute of limitations, the IRS can't reopen them directly. However, when auditing the current open year, say year 5, the IRS looks at the cumulative actual results from years 1 through 5 compared to the original projections for years 1 through 5. If that cumulative result is outside the 80-120 band, they can make an adjustment, but the adjustment itself only applies to the royalty payment for the current open year, year 5, and potentially future years.
Wow. So even if past years are closed, the past performance still dictates whether an adjustment is needed now. That seems like it creates perpetual uncertainty for companies licensing valuable IP.
It absolutely does. It necessitates ongoing review and potentially proactive adjustments by the taxpayer themselves if profits significantly deviate from projections. And this applies even if the payment wasn't a running royalty. What if they paid a lump sum up front?
Yeah, does paying a big chunk up front avoid these periodic adjustments, say $500 million for a 5-year license?
Nope, a lump sum doesn't buy immunity from CWI. The regulations treat a lump sum payment as if it were prepaid royalties. For testing purposes, the IRS will essentially convert that lump sum into an equivalent royalty amount for each year of the license agreement.
How do they do that? Like an amortization?
Sort of, using present value concepts to spread the lump sum over the years it covers, creating an imputed annual royalty rate. And that imputed annual royalty amount is then subject to the same 80%, 120% periodic adjustment test based on actual versus projected profits each year. So a lump sum offers no escape hatch from CWI review.
Okay. One more complexity with intangibles. What if one related company does something that increases the value of an intangible owned by another related company, like a distributor doing amazing marketing that really builds up the brand owned by the parent?
That's a really common scenario, often called developer sister rules or contributions to intangible value. If one controlled party, say the local distributor, performs activities, maybe unique marketing efforts, local R&D adaptations, building key customer relationships that go beyond routine functions, and significantly enhance the value of an intangible legally owned by another party, like the parent's global trademark.
The party doing the enhancing needs to get paid for it.
Yes, the contributor must receive appropriate arm's-length compensation for the value they added. They can't just build up the parent's asset for free. The compensation might take the form of a reduced royalty rate paid by the distributor, if they're the licensee, or perhaps a separate service fee paid to the distributor by the parent.
So the IRS could even impute a separate services agreement to make sure the local entity gets rewarded for building the parent's brand locally.
They certainly could. The key is that the compensation needs to match the value and risk associated with the enhancement activities. If the distributor undertook significant cost and risk to build that brand value locally, they should get a return commensurate with that contribution, perhaps even tied to the enhanced profits generated in their market. It has to reflect the economic reality of who created the value, #V, profitability-based methods, and the best method rule.
This whole discussion about the difficulties with CUP and CUT for unique goods and intangibles really underscores why finding perfect transaction-based comparables is often, well, impossible. Which must be why the regulations push towards using the best method rule, often leading to profitability-based methods instead.
That's exactly right. The best method rule is the overarching principle guiding the whole selection process. It mandates that the method you choose must be the one that provides the most reliable measure of an arm's-length result, given the specific facts and circumstances.
And reliability depends on?
It depends on two main things. First, the quality of the data. How complete and accurate is the data available for the controlled transaction and potential uncontrolled comparables? And second, the reliability of the adjustments needed to make the controlled and uncontrolled transactions comparable. If you have to make a whole bunch of large, subjective, or questionable adjustments to make a CUP work, it might be less reliable than a different method that uses broader data but requires fewer, more robust adjustments.
Okay, so if the transactional methods like CUP or CUT fail because of data gaps or adjustment problems, we often move to profitability methods. The most common one seems to be the comparable profits method, CPM. Why is CPM often seen as more reliable or practical than, say, RPM or cost plus?
CPM is often preferred, especially when you have good functional comparability but maybe less product similarity or iffy gross margin data. CPM evaluates the arm's length result by looking at the operating profit achieved by one of the controlled parties, called the tested party, relative to an appropriate base like sales or assets.
Operating profit, not gross profit.
Right, and that's key. Operating profit is generally less sensitive to differences in product characteristics and minor variations in accounting practices between companies compared to gross profit.
Why is that? Can you break that down a bit?
Sure. Think about all those costs that can be tricky to classify consistently, like freight, warehousing, discounts, maybe some administrative overhead. Whether a company puts those in cost of goods sold, affecting gross margin, or in selling general administrative expenses, SG&A, affecting operating margin, can significantly swing the gross margin percentage. But by the time you get down to operating profit, which is after deducting SG&A, those classification differences often have less relative impact on the overall profitability ratio.
So CPM uses metrics based on operating profit.
Yes, it uses profit level indicators, PLIs. Common PLIs include the ratio of operating profit to sales, operating margin, or the ratio of operating profit to operating assets, return on assets or ROA, or sometimes operating profit to total costs, BERI ratio, often for distributors. Because these PLIs are based on operating profit, they tend to be more stable and comparable across companies with similar broad functions, even if their specific products or detailed cost accounting aren't identical.
Okay, so you pick the tested party, usually the less complex entity in the transaction. Choose the best PLI for their function, find external companies that are broadly comparable in function, and then what? You check if the tested party's PLI falls within a range from those comparables.
Exactly. You gather financial data on the comparable companies, calculate their PLI results over a period, usually multiple years to smooth out anomalies, and then you determine an arm's length range of results.
And how is that range typically determined? Is it just the highest and lowest result from the comparables?
Not usually, unless the data is absolutely perfect, which it rarely is. If the data isn't complete enough to rule out all material differences between the tested party and the comparables, the regulations state that the arm's length range should normally be established using the interquartile range.
Interquartile range. So from the 25th percentile to the 75th percentile of the comparables results.
Correct. You basically rank the comparables PLI results from lowest to highest, and then you lock off the bottom 25% and the top 25%. The range is the results falling between the 25th and 75th percentile marks.
Why do that? Why throw out the top and bottom quarters?
It's a statistical technique to improve reliability. The idea is that the companies at the extreme ends, the ones making unusually high profits or significant losses, might have unique circumstances or factors affecting them that aren't really comparable to the tested party. Using the interquartile range focuses the analysis on the central, more representative portion of the market data, making the resulting range more robust and less susceptible to distortion by outliers.
Okay, that makes sense statistically. And if the tested party's own PLI result falls outside this interquartile range, say it's below the 25th percentile,
Then an adjustment is generally required to bring the tested party's income into the arm's length range.
and where does the IRS typically adjust the income to? Just up to the bottom of the range, the 25th percentile?
Ordinarily, no. The adjustment is usually made to the median of the range. The median is the 50th percentile point, the middle result within the interquartile range, and also the middle result of the full set of comparables.
Why the median?
Because the median is considered the single most statistically reliable point estimate of an arm's length result within that distribution. Adjusting to the median ensures the taxpayer's result is brought squarely into the central tendency of the market comparables, not just barely scraping into the acceptable zone.
That seems quite rigorous. Okay, but CPM works best when one party, the tested party, is doing relatively routine things that you can find comparables for, right? What happens if the transaction involves both sides contributing really unique, valuable things, especially intangibles? Like maybe one company has the core tech patent and the other has developed unique market access and brand value.
That's the exact situation where CPM breaks down. CPM relies on testing just one side of the transaction, assuming the other side will get whatever profit is left over, the residual. If both parties are contributing significant, unique, non-routine value drivers, especially valuable intangibles, then neither side is really routine, and you can't reliably benchmark just one of them.
So for those highly integrated, complex transactions involving shared, unique contributions.
You generally have to turn to the profit split method. This method acknowledges that both parties are acting entrepreneurially and aims to divide the combined profit or loss from the transaction venture between the controlled participants based on their relative contributions.
How does that work in practice? The most common form is the residual profit split, RPS, right? It seems like a two-step process.
Yes, the residual profit split is often the most applicable version, and it is a clear two-step process. Step one is the allocation of routine returns.
Routine returns. So first you give each party a basic profit for the simple stuff they do.
Exactly. You first identify the routine, non-unique contributions made by each participant. This might be things like basic manufacturing under contract terms, standard distribution services, administrative support, providing financing at market rates. You then use external market data, often using methods like CPM or cost plus, applied just to those routine functions to determine a market-based return for those routine activities. You allocate that routine profit to each party first.
Okay, so if the European subsidiary EC handles manufacturing and basic distribution, you figure out a normal profit for those functions based on comparable contract manufacturers and distributors, and you give that slice of the pie to EC first.
Precisely. You do that for all participants based on their routine contributions. Once you've allocated the market returns for all the routine stuff, whatever profit is left over is the residual profit.
And this residual profit represents the extra value, the super profit, generated by the unique, non-routine contributions, the valuable intangibles.
That's the idea. The residual is presumed to be attributable to the non-routine contributions, particularly the unique intangibles that both parties brought to the table.
So step 2 is splitting this residual profit. How do you decide how to split it?
Step 2 is the allocation of the residual profit. The residual profit, or loss, is divided between the controlled participants based on the relative value of their non-routine contributions.
Relative value. That sounds subjective. How do you measure the relative value of, say, a core technology patent versus deep market knowledge and brand development?
It can be subjective, and this is often the most difficult and contentious part of a profit split analysis. The regulations suggest looking for the most reliable measure possible. Often, this involves looking at the relative investment made by each party in developing their respective non-routine intangibles.
Like in that Nulon example.
Yeah.
Where XYZ in the U.S. developed the core patent for the bulletproof materials, spending on R&D, and its subsidiary, XYZ Europe, developed crucial modifications for the European defense market and spent heavily building the brand and market access there, spending on local R&D and marketing.
Exactly. In that kind of case, a common approach is to look at the capitalized costs incurred by each party over the years to develop their specific valuable intangibles. You might compare XYZ's capitalized R&D spending on the core patent against XYZ Europe's capitalized spending on market-specific development and brand building, perhaps adjusted for time value or amortization.
So if XYZ spent, say, $60 million developing the patent, and XYZ Europe spent $40 million developing the market-specific enhancements and brand, the relative contribution is 60-40.
That would be the logic, yes. You'd then split the residual profit, let's say it was $180 million, after allocating routine returns according to that 60-40 ratio. So XYZ US would get 60% of the residual, $108 million, and XYZ Europe would get 40%, $72 million.
Plus their routine returns calculated in step 1.
Plus the routine returns, exactly. The RPS method forces you to really dig into where the unique value creation is happening within the group and ensures that the profit allocation reflects the relative importance and investment in those key value drivers. It implicitly recognizes that significant value is often created through the combined efforts and unique contributions of multiple group members, not just in one place. #TagRikarai, services, transactions, and cost allocations.
Okay, we've covered loans, tangible goods, and intangibles. Let's turn now to the world of intercompany services. This is another huge area, everything from centralized HR and IT support to specialized legal or consulting services provided between related companies, and another area where shifting costs or avoiding markups can be tempting.
Absolutely. Services are pervasive in multinational groups, and the regulations, specifically Section 1.482.9, provide specific guidance. Recognizing that benchmarking every single routine internal service can be burdensome, the rules offer a potentially significant simplification for certain types of services. The Services Cost Method, SCM.
The SCM. This allows companies to charge for some services at just the cost incurred, with no profit markup added.
That's right. If a service qualifies for the SCM, it's generally considered the best method, and the arm's length charge is simply the provider's cost of rendering the service, with no additional profit element required. This can save a lot of time and effort in finding comparables for routine, low-value services.
But surely not all services qualify for this cost-only treatment. What are the requirements?
No. Definitely not all services. The eligibility rules are quite specific. First, the service must be a covered service, as defined in the regulations, and second, critically, it must not be an excluded activity.
Okay, what generally counts as a covered service? And what's definitely excluded?
Covered services are typically routine, back-office, supporting activities. Things like payroll processing, basic accounting and bookkeeping, general administrative support, routine IT help desk functions, perhaps standard HR administration, or basic tax compliance support, things that are supportive but not core to the business's competitive advantage.
And the excluded activities, where you can't just charge cost.
The excluded list covers the more strategic, high-value, or risk-bearing functions. This includes things like manufacturing, production, extraction, construction, research and development, R&D, financial transactions like lending, guarantees, or trading, insurance or reinsurance, and critically, any activity that involves the assumption or control of significant risk or the creation, ownership, or use of valuable intangible property.
So core business operations and high-value functions are out. But even for services that aren't explicitly excluded, there's another big hurdle, right? This business judgment rule.
Yes, this is a very important qualitative test. Even if a service isn't on the excluded list, it only qualifies for the SCM if the taxpayer can reasonably conclude in its business judgment that the service does not contribute significantly to the group's fundamental operations or competitive position.
How is that judged? What does not contribute significantly mean here?
The regulations frame it around three things. The service must not contribute significantly to 1. Key competitive advantages, core capabilities, or fundamental success or failure of the business. 2. The generation of significant income or cost savings. 3. The assumption or control of fundamental risks of success or failure.
Okay, that sounds like it requires some real thought. Can you give an example of a service that might seem routine but could fail this business judgment rule test?
Sure. Let's take internal legal services provided by the parent company. If the parent's legal team is just providing routine contract review for standard sales agreements for a low-risk manufacturing subsidiary, that might qualify for SCM. But consider a different scenario. What if that same internal legal team at the parent company has highly specialized expertise in, say, navigating environmental regulations, and they are providing critical advice and representation to a subsidiary operating a chemical plant? Failure to comply with those regulations could lead to massive fines, plant shutdowns, catastrophic reputational damage, fundamentally impacting the success or failure of that subsidiary and maybe the whole group.
So even though it's an internal support function, its impact is potentially huge and directly related to fundamental risks.
Exactly. In that case, the taxpayer probably couldn't reasonably conclude that the legal service doesn't contribute significantly to managing a fundamental risk of success or failure. Therefore, SCM would likely not be available, and the service would need to be charged at an arm's-length price, including a profit markup, determined using other methods, like comparing to external law firm rates for similar specialized advice.
So the context and criticality of the service really matter, not just the label. Okay, assuming a service doesn't qualify for SCM, or even if it does but benefits multiple group members, how do the costs need to be handled? Specifically, allocation of costs.
Right. When services are provided that benefit more than one related party, think of centralized IT infrastructure, shared HR platforms, or global marketing coordination, the costs incurred by the service provider must be allocated among the recipients.
On what basis?
First, the cost to be allocated must generally be the full cost, not just the incremental or marginal cost of adding one more user. So if you run a central IT server farm, you can't just charge subsidiaries the extra electricity they cause. You need to allocate a fair share of all the costs: hardware depreciation, software licenses, maintenance, personnel, facility costs, everything.
And how do you decide each subsidiary's fair share?
The allocation must be based on a reasonable method that reflects the benefits received by each recipient. The method should be consistent and systematic. Common allocation keys include things like relative sales revenue, assets employed, headcount, employee compensation, units produced or sold, number of transactions processed, or even time spent by the service provider's personnel on matters related to each recipient, if that can be reliably tracked. The key is choosing a basis that most closely relates to why the cost was incurred or how the benefit is derived.
Now, are there any costs incurred by, say, a parent company that should not be allocated to subsidiaries at all because they don't really benefit the subsidiary?
Yes, definitely.
Yeah.
The regulations carve out something called shareholder activities. These are activities performed by a parent company or another group member acting like a parent that are primarily for the parent's own benefit in its role as an investor or owner, rather than providing a specific, identifiable benefit to this subsidiary's operations.
What are some typical examples of shareholder activities?
Classic examples include activities related to the parent company's own legal structure or reporting obligations, like preparing and filing the parent's consolidated financial statements for SEC reporting or stock exchange listings. Costs of raising capital for the parent's own acquisition activities. Costs associated with parent company board meetings or shareholder relations, performing internal audits or reviews that are solely focused on monitoring the parent's capital investment in the subsidiary, often called stewardship activities, rather than providing operational benefits or improvements to the sub.
So the subsidiary doesn't have to pay for the parent managing its own affairs.
Basically, yes. If the activity primarily benefits the parent in its capacity as a shareholder, the costs are generally not allocable to the subsidiary as a service charge. The benefit to the subsidiary, if any, is considered too indirect or remote.
But what if there's overlap? Like, the parent compiles data for its own SEC filing, but the subsidiary then uses that same readily available data package to help prepare its local regulatory filings more easily. Does it become a chargeable service then?
Ah, that's where it gets nuanced. If the subsidiary receives a specific identifiable benefit from the activity, even if the activity also benefits the parent, then it's generally not considered a pure shareholder activity. In your example, if using the parent's data package saves the subsidiary tangible time and cost in preparing its own local filings, compared to gathering and compiling the data itself, then the subsidiary has received a direct benefit.
So some portion of the cost related to preparing that data might need to be allocated.
Yes, at least the portion related to the benefit the subsidiary received. The presence of some shareholder benefit doesn't automatically prevent allocation if there's also a clear, direct benefit flowing to the subsidiary's own operations or compliance needs. You have to analyze the primary purpose and the locus of the benefit.
Okay, one last area under services. What about high-risk services like R&D, where the outcome is really uncertain? Can payment be tied to success? Let's talk about contingent payment arrangements.
Yes, payment for services can be contingent on future events or benefits, but again, the arrangement has to make sense from an arm's-length perspective. This often comes up with contract R&D. Can a parent company perform highly speculative R&D for a subsidiary, where payment is only due if the R&D leads to a successful commercial product years later?
Is that allowed?
It can be, but the structure needs to genuinely reflect the economics. A contingent payment arrangement for services is generally respected only if several conditions are met. The arrangement must reflect the recipient's benefit. For example, payment tied to actual profits from the R&D, and it must reflect the renderer's substantial risk. Crucially, the renderer, the party performing the service and waiting for payment, must have the financial capacity to bear the risk of non-payment if the contingency doesn't occur, and must exercise operational control over the activities that influence that risk.
So it ties back to those same risk principles we discussed earlier.
Yes, exactly. Let's say the parent performs super high-risk, blue-sky R&D for a subsidiary. The contract says the sub only pays the parent based on future sales, if sales materialize. That sounds contingent. But what if the parent entity doing the R&D is hugely capitalized, as all the world-class scientists controlling the project, and the subsidiary is just a shell company with no real assets or decision-making power?
The risk isn't really being borne by the subsidiary waiting for the results. It's being borne by the parent doing the work.
Precisely. The economic substance doesn't match the contingent payment structure focused solely on the subsidiary's future sales. An arm's-length party performing such high-risk R&D would likely demand a different compensation structure, maybe milestone payments or a share of potential upside through royalties or some guaranteed funding, rather than a purely contingent payment based on the recipient's success when the renderer is bearing all the functional risk and control.
So if the contingent payment structure lacks economic substance, the IRS could disregard it.
Yes. They might impute different terms that do reflect the actual risk and function profile. For instance, they might recharacterize the arrangement not as a service for contingent payment, but perhaps as a joint venture in R&D where both parties share costs and outcomes, or treat the parent as the developer who should own the resulting IP and license it to the subsidiary for an appropriate royalty. The payment structure has to align with who is actually doing the work, taking the risk, and controlling the process.
Wow. Okay, this has been an incredibly detailed journey through Section 482. We've gone from, the seemingly simple interest rates on loans and the safe haven, all the way through tangible goods pricing with CUP, RPM, cost plus, then into the really complex world of intangibles with CUT and that powerful commensurate with income standard, and finally navigating services with the SEM and contingent payments. It really covers the waterfront of internal corporate dealings.
It really does.
Yeah.
And I think the unifying theme, the thread running through all of these disparate rules for loans, goods, intangible services, is this relentless focus on economic reality. The transfer pricing regulations are not just a set of arbitrary accounting rules. They represent the government's comprehensive attempt to enforce the substance of arm's-length dealings, to ensure that the way related parties interact internally mirrors as closely as possible how unrelated parties would interact in the open market.
Yeah, whether it's the best method rule demanding the most reliable outcome, or the arm's length range trying to capture market variation, or the CWI standard looking back at actual profits, or the requirement that financial capacity must genuinely back up risk assumption. It always comes back to testing the internal setup against that external arm's length benchmark.
Exactly. It's about consistency. Are the contractual terms consistent with the party's actual conduct? Are both consistent with the underlying economic substance? And does the resulting profit allocation align with the functions performed, assets used, and risks assumed by each party as judged by market standards?
And the implication for multinational corporations is huge. This framework essentially forces them to meticulously document their internal dealings, justify their pricing, and ensure their day-to-day operations align perfectly with that documentation and the arm's length principle. It really makes tax compliance an integral part of operational strategy.
Which brings us maybe to a final provocative thought for you, the listener, to ponder. We've seen how the Section 482 regulations give the IRS significant power, the power to look beyond formal contracts, to disregard terms that don't match reality, even to impute new terms based on actual conduct. Given this regulatory power and the immense burden of documentation required to demonstrate functional and economic comparability, to what extent does this complex framework perhaps incentivize companies to prioritize internal conduct and documentation consistency almost above the actual strategic flexibility or entrepreneurial agility they might otherwise pursue in their global operations?
Does the need to fit neatly into the tax box sometimes constrain the business possibilities?
It's a question worth considering. It's a framework that undeniably demands tax compliance be woven into the very fabric of every significant business decision made by a multinational group anywhere in the world. It's not just a year-end calculation. It's an ongoing operational reality.